So let's talk about it. Joining us, Larry Adam. He is Chief Investment Officer of Raymond James. Larry, job number, not good. Market, good. We're at session highs. More records across the board. Are you surprised?
I am a little bit surprised that the market continues to move higher. I mean, we just had a fantastic summer time period where we were up 12%. That was the third strongest summer that we've had in a long time. And I'm always of the belief that good news is good news and bad news is bad news. And right now, I do think that tomorrow, I wouldn't overstate tomorrow's importance because, as you just mentioned, I think a composite of all this economic data does point to the fact that the employment conditions are weakening, whether that's the Beige Book, the ISMs that have come out, the ADP, JOLTS, all of them are pointing to a weaker number tomorrow.
Yeah, the Beige Book, as we pointed out yesterday, higher number of references to tariffs and inflation than the previous Beige Book. The ADP number was weak. Probably tomorrow we'll see what happens. We got by the way, a new head of the BLS, and you don't want to go into the politics of it, Larry, but I'll venture to guess this, whichever way that number comes in, one side or the other of the political spectrum is going to discount it. How will the market react?
I think you bring up a good point because what's really been driving the market has been revisions. And I think tomorrow, when you look at those revisions, just think about this. If we have anything like we had last time, you're talking about the possibility that May and June numbers could actually go negative. And I think that that's one of the tail risk of tomorrow's numbers, that if you do see negative numbers, I think that could spring forward some of the rate cuts that the Fed could potentially be looking to do in the near term here. The other thing I'd mention is that, when we talk to our economists, the fact is that revisions are nothing unusual. Everybody points to the fact that these surveys are a lot lighter with the first tranche of responses that come in. And usually that's true. It's usually around 60%. But by the second or third response, it's usually up to like 90, 95%. And one of the reasons why we think that occurs, and one of our expectations, at least mine is that oftentimes if you're hiring somebody, you kind of report that, right? If you haven't really hired anybody, or if you've laid people off, you tend to be a little late to respond. And I think that's why you've seen some of these downward revisions here of late when you get the second and third revisions.
I think it's an excellent point, and it's an important point. Let me ask a different point. Does the jobs number even matter that much? I mean, I think it should, but with the changes at the top, all the revisions, the change in methodology, a lot of people not answering landline phones anymore, employers sort of delaying or not at all answering some of these questions. Larry, how much are you and your team actually even looking at the data?
Look, unless it's a tremendously outsized number tomorrow, and what I mean by that, the consensus is at 75,000, unless we get a blowout number of north of 150 or well below 50, I don't think it's going to be a market-moving event. I think the bigger story is going to be next week when we get the inflation numbers. Because if you look at the dual mandate, I think it's clear that the economy is slowing, particularly when it comes to employment. Next week, when we get those inflation numbers, from our economics view, we think that that's really the first sign you're really going to start to see these price increases starting to flow through to the data. And if that's the case, that'll just make the Fed's job a lot more challenging going forward.
Yeah, well, what if we get a blowout number tomorrow? Let's say it is above 150,000, as you just mentioned. Well, are all bets off then on Fed rate cuts in 2 weeks?
No, I don't think it'll be off for September, but I think if you get 150,000 plus tomorrow, I think then you start to throw some uncertainty about October and then December. Because I think the die has pretty much been cast for this particular meeting, particularly with a lot of the Fed governors out there. Even today, Williams talking about the fact that it looks like they're going to cut. But I do think, given some more time, it would cast some doubt on those cuts later in the future.
All right. Anything specifically with the stock market, besides jobs, besides the Fed, that you are watching the most closely right now, Larry?
Well, there's so many headlines out there that we end up trying to dial back a lot of them, right? A lot of people talk about it.
You can't pay attention to everything.
No, agreed. And look, again, with things with Governor Cook, right? We talk about the fact that, that's a lot more headlines. The reality is that the Fed is going to probably cut rates. That die has already been cast. And she was already considered a dovish participant, right, from her policy perspective. So I don't think that that's a big thing for the market. And I think one of the things that the market is learning this year, and that is not to overreact initially to policy initiatives. And what I mean by that, if you think about it, this year, there have been a lot of missteps by the market, right? Tariffs are bad for the economy. They're bad for the market. Well, that hasn't happened. Deportations are going to be bad because it's going to lead to wage pressures moving higher. Well, again, that didn't happen. The passing of the OBB is going to lead to a spike in interest rates. That hasn't happened. So I think when it comes to Cook and what the Fed is doing and Fed independence, I think the market's in a wait and see mode here to ultimately see what's important and how are the fundamentals, meaning the economy and earnings, actually doing.